I'd like to talk a little bit about the demand and supply of money and how that's related to interest rates and a brief introduction to monetary policy using supply and demand curves. So, like many economic relationships, economists like to think about the money supply in terms of the amount of this thing that's demanded by consumers and how much of this thing is supplied. Now, in this case, the supply is not from producers of goods that are trying to maximize profits. The money supply here is going to be affected primarily by decisions of a central bank or a central government to change the amount of money in circulation. Recall that the money supply, the money that we're talking about in this course is assets that are acceptable for purchase of goods and services, sort of in a normal course of affairs in an economy. So I'm going to depict the money supply. So that's going to be MS. Now, in a previous video, we talked about M1 and M2. Let's not worry about the distinction between these two, but the M here the MS is that supply of either one, based on either one of those definitions. Now, you'll see that I've divided this by the overall, so let me write this down. So this is the money supply, the nominal money supply, divided by the overall price level for the economy. What we're trying to get a sense of is the kind of the purchasing power, if you will, of the physical currency and demand deposits in circulation. That part's the nominal money supply, how many pieces of paper, if you will, that the government has printed and put out into the economy. But you need to take into account the price level when trying to determine what the value of that currency is in actual transactions in the economy. So if the money supply was, say, $10 trillion and prices of goods were very low, that $10 trillion could go pretty far. If that same $10 trillion was in circulation when prices were 10 times as high as before, then the purchasing power of that currency is a lot less. So we will talk about the real money supply and sometimes referred to as real money balances. Okay, this is sort of an economics jargon term that I'm not going to use, but you're really talking about the money supply, nominal money supply adjusted for prices or inflation. Okay. When the government prints money or conducts an open market purchase, it's going to be changing the numerator here. It's going to be changing the money supply in circulation. Prices be another story, but we'll talk about that. Okay, so there's the money supply. Now let's think about money demand. This asset, money, is going to be demanded by private citizens who are undertaking those three goals that we talked about in another video, using money as a medium of exchange, a store of value, or a unit of account. I'm going to kind of set aside the unit of account story here and to focus on two primary sources of the demand for pieces of paper, money in circulation. One is the store of value, and the other is the medium of exchange. So I want to do this thinking on the first one of holding cash, currency, or stuff in a checking account, as opposed to earning interest by loaning these funds. So I want to think about this for a second. If I've got, say, I've inherited $10,000 from my grandmother. Okay, I've got cash. Okay, I can hold that, put it in a checking account, have it ready to buy goods and services, or I could potentially take that cash and putting in a savings account, or buy a bond, a $10,000 bond. I can earn interest as an alternative to holding currency in this liquid form. So a liquid asset is one that you can be easily turned into transactions for buying goods. So when I'm looking at how much money people are willing to hold, we need to take into account the alternative use of the asset, which is to earn interest. So we're going to have that money demand, and this is traditionally called L. It's liquidity demand is actually what the L stands for. It's how much money is demanded is going to depend on the interest rate, because you can hold the bond instead of the money. And the other is Y, which is GDP. The more GDP goes up, the more goods and services that are produced, the more cash that people will need to undertake transactions. So that's the other part of the money demand here. So we've got you may need more cash, more checking accounts, more currency, more coins when income goes up and people want to undertake transactions to buy stuff. So the demand for money depends upon, is a function of the interest rate and income. Now, it is negatively related to interest rates. As interest rates go up, it becomes more costly to hold cash, and so the demand for money would tend to go down. So the interest rates and the demand for money tend to go in opposite direction. Nominal interest rates go up. You want to save instead. You don't want to hold cash. The demand for money goes down. And income is positively related to demand for money. GDP goes up, people use more cash, demand for money rises. So traditionally, this supply and demand for money is depicted with quantity of money on the horizontal axis, so it's quantity, kind of standard supply and demand story, and the interest rate on this axis. Now it's tempting to think of interest as the price of money, and people will kind of loosely do that. You don't have to pay for money. Now you may have to pay for a loan, to borrow money. The interest is really the payment for loanable funds. the cost of loanable funds. It's going to be related to the opportunity cost of holding cash, but it's not the price of money. It's the price of bonds. But it's clearly related to the demand for money. Now, money supply doesn't depend on the interest rates. Okay, the government decides how much money to put into circulation or influences it. We'll get back to money supply creation in a different video. Okay, so there's the money supply. And that does not vary with the interest rates. Okay, it's a decision by the combination of the central government, central bank, and banks. We'll talk about that later. But it doesn't depend directly on the interest rates. You know, the Fed can create more funds. They don't have to pay the interest rate. It's sort of their own decision. And the demand for money is downward sloping when you write interest rates on the horizontal axis. In other words, money demand will fall when interest rates, money demand will rise when interest rates fall. Why? Because the opportunity cost of holding cash is lower because the interest rate on savings goes down. You know, it's not that big a deal to hold cash if interest rates are really low. And the shape of this demand curve for money is something that we'll talk about in another video, but it's basically downward sloping. Now, not surprisingly, economists are going to be pretty excited about where these two lines cross. That's the equilibrium interest rate. That's the interest rate that will get supply equal to demand for money, and also so this shows an equilibrium in the supply and demand for money, and also in the bond market. Got a separate video about the bond market, but I want you to really keep in mind that the bond market and this supply and demand for money intimately related. So let's think about this to use this supply and demand for money story. Let's imagine that we're going to keep prices fixed for now. So the overall price level is fixed, and let's let the money supply go up. Now, to kind of put a concrete example on this, in the 2009, 2008 great financial crisis, the Federal Reserve in the United States increased the money supply. They did open market purchase. Again, that's a separate video. Increased the amount of currency in circulation. What that does, it's going to shift the supply curve out for money. Prices staying the same and M is going up. It's going to shift to the right. And what you see is that you have a drop in the nominal interest rate. This is how central banks try and influence the economy by conducting monetary policy, expansionary monetary policy, which will lower the interest rate. That lower interest rate can affect the ability of firms to expand output. It can affect the ability of potential homeowners to buy a house. It can affect someone's ability to borrow for a new car, or students to go to graduate school. So we use this demand and supply of money in many instances to analyze various types of macroeconomic policies, especially on the monetary side, using money supply and bond market intervention. Okay, so that is a quick introduction to the supply and demand for money.